2 weeks ago, I put the oil tanker stocks in the sell block. Now, I haven't liked this group for a long time, mostly because of oversupply in the tanker market. In other words, there's just too many ships, and that hurts the day rates that the tanker companies can charge. Plus, most of these companies have ugly balance sheets, along with complicated ownership structures, where many of them are subsidiaries of other companies. You know I never like owning subsidiaries. Even worse, management at Frontline, one of the largest oil tanker companies out there, has said there could be 5 more years of pain before things get better. But I am always open-minded, especially when a CEO is willing to come on the show and defend his business. Always. In this game, you got to be flexible. We welcome the other side. Now, that said, we had the management of a dry bulk shipper, different industry, shipping, but for dry bulk, that was Baltic. I had told you to sell Baltic. Stock was at 13. Management came on, defended itself. Stock's now at 6. Confirmed our skepticism. On the other hand, sometimes the CEOs make us a lot of money, like Travelzoo did when their chief executive officer came on the show at the end of February. After some bearish lightning round questions, stock rose from the low 40s to 100 back in April. Now, in that sell block that I did on June 2nd, I singled out Teekay Tankers, TNK for all you home gamers, largely because TNK has historically bought its ships from its parent company, Teekay Corp. I'm also concerned about the dividend. Stock currently has a sky-high 11.5% yield. I want to know if that's a red flag. Can it be maintained if the tough dynamics of the tanker biz continue? Stock has come down about 6% since I put the sector in the sell block 2 weeks ago. It was trading at $9.26. But again, I'm willing to air the other side of the story, and I just want to hear the other side. Tonight, Teekay Tankers CEO Bruce Chan is here to make the case for his business. Mr. Chan, welcome to Mad Money.
Thank you for having me on, Jim.
Sir, here's what I want to do. Because you are a good man coming on the show, I'm going to turn the show's floor over to you. Tell us why we should we should like your business and why we should buy your stock.
Well, thank you, Jim. I've watched your other segments on our industry, obviously, and we do agree with a lot of your points in general on the industry. It currently has a lot of supply. As we like to say, after every party, there's a hangover, and that's what our industry is going through right now. The party was in the mid part of the 2000s. We had extremely high rates, and shipping companies went out and ordered a lot of ships, and those ships are coming on the water now. And so that's causing, as you correctly point out, a significant drop in day rates. But as we know, with every hangover, there's another party around the corner, and we think that's where we're heading in our industry. But as we headed into this current hangover, fortunately, we anticipated that at Teekay Tankers, and we were able to secure good fixed-rate business for periods of 1 to 3 years to tie us over through this downturn. It has allowed us to generate positive cash flow in the worst tanker markets in a long time and be able to pay a very solid dividend. And then why do we think the market is going to rebound going forward? Well, in these days now, there are no ordering of new ships. The market is so low, people don't have the cash or see that this is not the right time to order new ships. And so this year, we are seeing the lowest ordering of ships in 25 years. And if you take it over a 3-year period, the last 3 years of ordering, that's been the lowest ordering of new ships since the late 1990s. And so it's that low ordering of ships in the late 90s that helped bring about the upturn in the markets in the following 10 years. And we believe that this low period of ordering that we're seeing now is the classic signs that help a cyclical industry like tankers rebound.
All right, well, let's go over your excellent presentation that you did. This is the May 12th earnings presentation. It's available on the web. You talk about you have this terrific dividend matrix where you talk about how you can maintain this dividend with the Suezmax spot rate assumptions, and you also talk about that you're largely insulated from near-term spot market volatility with 60% fixed coverage for Q2. What happens, sir, when those contracts come off if the day rates stay this low?
That's right. I mean, that dividend matrix is exactly what I think you like about companies, Jim, and we're trying to provide absolute transparency to our shareholders so they can see what the dividend is. And as we anticipated this downturn, we were able to insulate and be able to provide for a dividend with generating cash flow in this low market. As we say, we see the signs of the market rebounding, and so we've tailored this portfolio to run off as we see the market having the seeds to be an upturn in 2012 and beyond. Will it be perfectly timed? That's no company is going to perfectly time it, but we believe we have set up our portfolio to be running off at the rough time that we think the market will be rebounding in the cycle.
Okay, we have historically been shied away from owning a subsidiary because we always feel that a parent can, if push comes to shove, hurt the subsidiary and do better than the subsidiary. Why, in this case, is the subsidiary so attractive?
Well, this is at Teekay Tankers. We own 100% of the ships. All of the fixed-rate charters are to third parties, so there is no real subsidiary relationship in that sense to the parent. What our sponsor, like an MLPs, provides is a bigger footprint, a bigger commercial footprint, both in terms of the revenues we can generate because we have a larger presence in the market with customers, as well as scale benefits for costs. As you always say, Jim, in this industry, we have high-cost companies out there. But our scale at Teekay overall allows us to have scale efficiencies in our operating and capital expenditures in maintaining ships to a high standard. So those are clear benefits we get from a strong sponsor. One
last question in the short time we have. We're obviously driven in somewhat from what some of your competitors say. Frontline was so negative that, frankly, it frightened us. 5 years of downturn. Could they possibly be too pessimistic?
I think there is definitely a chance that they are overly pessimistic. I don't think anyone out there has the crystal ball to predict exactly when it is. We just look at the signs that we can see and take our best look going forward. And our view is that the low ordering of ships, as well as the healthy demand for oil continuing, with the IEA today reporting that they're seeing 1.3 million barrels a day of increased oil demand over the coming 3 years, we see that the signs are there for the recovery sooner than what Frontline is probably predicting.
Mr. Chan, you make a really good case for your company. I thank you so much for coming on the show.
Thank you for having me, Jim.
Absolutely. That's Bruce Chan, CEO of Teekay Tankers. Look, I feel better. I think the matrix, the work he's done, the things he's saying, they make a lot of sense to me. I think you should examine the situation yourself. And I think gotta tell you, it's pretty interesting. Stay with Cramer.